Good afternoon, and thank you for joining us for today's webinar, where we'll discuss filling the growth gaps in your strategic plan. My name is Sean O'Brien, the president of QuickRate, and I'm pleased to be joined today by Tim Keith, CEO of Infusion. As you know, Infusion acquired QuickRate earlier this summer, and this continues a process of trying to introduce to you some of the real positive benefits that Infusion services can offer our credit union clients. Today, we're going to talk a little bit about, filling in those growth gaps in your strategic plan. Many of you may be in the midst of or beginning, your budgeting process for next year, your strategic planning processes. And we just felt like this was an opportunity to share with you information that can be gleaned from your own data through an opportunity assessment. And again, we just all know from experience, better information is going to, ultimately lead to, better decisions and outcomes. So we just felt like it was a very timely piece of information we wanted to share with you. And at this point, just a reminder, we will send out a copy of the slides used today, along with the link to the recording. If you have any questions, certainly submit those through the Q&A feature or the chat feature. We'll monitor those and take those in the midst of the discussion or at the end of the presentation. And at this point, I will turn it over to Tim, who will take you through the presentation. Tim?
Great. Thank you, Sean. And thanks to all who are participating. It's great to be with you today. I'm going to turn my camera off to save bandwidth, and we'll jump right in. So a little bit about Infusion. We were started 17 years ago this December, actually right when the financial crisis hit. But our heritage goes back almost 35 years to a predecessor company called Fusion Marketing Group. And at that point, MCIF systems were first coming into the industry, and we were kind of on the vanguard of helping clients understand their member data and how to try to analyze it and utilize it to grow in key categories. And so fast forward to 2024, and we have just gone over 18 billion in deposits and loans generated through our partnerships with our community financial institutions that we've worked with over the years. Infusion is strategist-led, so our strategy team leads our client engagements, and all of our strategists are veteran credit union and bank executives. Personally, I did a couple stints in banking, including running consumer banking at First Tennessee Bank for a number of years, which included the 04 to 07 rising rate cycle that has some similarities to the cycle that we've just been through. In our particular case, we were a very illiquid company, growing loans much faster than deposits. Interest rates start going up, so that creates a dual challenge of funding liquidity, but also competing for deposits in a rising rate environment. Some of you have experienced that over the last 3 or 4 years. And so as we kind of transition to the subject of how to do budget planning, particularly for 2025, I would say it's uniquely challenging where we are right now. If you think of everything that's happened in the last 4 or 5 years in our operating environment, where coming into the pandemic, loan growth was pretty solid. We're mostly looking for funding and deposit funding. The pandemic hits, interest rates dropped to 0% overnight. That's followed by a historic amount of federal stimulus poured into the economy, much of which piled into our checking and savings accounts. And so all of a sudden now we're trying to lend out that money. And just about the time we thought we would always be liquid, we have spiking inflation and one of the most, if not the most aggressive rising rate cycles we've seen. And we're having to fight for deposits and try to hold on to as much of margin as we can as we're trying to make sure we're adequately funded, and that we're able to compete to retain the funding we need. So any one of those things would have created challenges in our planning processes, but you put all of those together in a 3-4 year period, it's just uniquely challenging to try to have a coherent strategy that we can stick with. And if you look at, forward into 25, we're not sure what's going to happen with rates. There are various speculations. I think 2 days ago, different Fed governors gave different opinions over, what they think is going to happen with rates. So we really don't know, but we have to make plans based on the best information that we have. I would say for most of our clients last year, 2023 was all about liquidity and making sure we had our funding needs covered. 24 has been more about trying to manage profitability and cost of funds, expenses, and so forth. I think 25, we're really going to have to start looking forward to how are we going to grow. And if rates do continue to go down, that should help us with asset growth. But what we want to try to do is lean on data as much as possible to drive our planning, and lean on data analytics processes and get the infrastructure in place. So as things shift in ways we may not anticipate, we have the tools available to shift our plan to be realistic and consistent with what we're trying to achieve as institutions. So what you see on the screen here is kind of a four-phase approach that we'll talk about today. How do we assess where we are and what our opportunities are? How do we use that as a jumping off point for planning? How do we then act on those plans? How do we evaluate the impact of our actions? And then start the loop again, readjust. And so that we use the word discipline as much as anything else to refer to this process. Assess, plan, act, think. How do we set those disciplines up to do this on a repetitive basis so we're able to achieve the goals and objectives we have as organizations? So where do we start in assessing opportunity and planning in this process and so forth? And it's kind of an obvious statement, and but I would say that we can't map out a route to where we're trying to go as an institution without having an accurate understanding of where we're starting. Many of you may have had the same experience that I have fairly regularly as I travel, where I get to an airport and I pull up Uber. I'm trying to get an Uber to where I'm going. So I know where I'm going. I put the address in there, but Uber can't accurately locate me. And I know I'm not going to get where I'm going. I'm not going to get in that Uber and go where I'm going until that happens. And so that analogy, having an accurate understanding of where we're starting, is fundamental to building a plan that's going to get us where we're trying to go. And so benchmarking is always valuable, I think, but given everything that's happened the last 4 years, 5 years, it's never been more valuable than it is today. And so, a benchmarked view of your data compared to your peers gives us the ability to identify distinctive strengths of our organizations that we might be able to leverage more fully, gaps that correspond with product areas where we're looking to grow. Attrition risk factors are kind of like icebergs under the water that we want to be aware of, we want to quantify, and we want to be proactive in navigating. So that's what a good benchmark analysis will give you, that sort of SWOT analysis sort of thing. And we use this OA, here's opportunity assessment. That's our approach to benchmarking. But let's be honest, the best benchmarking analysis or analytic reports in general are limited in value if we can't use them to plan, if we don't have the what do you do about it part. So you've got to have a jumping off point to planning. So an assessment that drives a plan, and not just a plan, a set of bullet points in a PowerPoint, but actual projected, pro forma projected plans that sync up with our budget, that are reliable and particular to categories, that sync up with our budget and our goals and objectives as an institution. Of course, a plan's not any good if you can't execute. So we've got to be able to execute, and we got to execute with the best available data we have at the point of execution. And then I would submit that, tracking the impact of our actions as we execute is more important than it's ever been, because there's so many variables in play between interest rates, competitive issues, compliance related issues, and so forth, that the ability to track back our efforts to our goals, and then even bring in, which we help clients do, how did the actions that I took and the impact of those actions compare to what other credit unions did during the same period? And how can I take all of that information and adjust course as I go back and execute again, and then ultimately come back to the benchmarking and ask the question, are all these activities I'm undertaking moving the needle from a bigger picture macro perspective? And so this continuous loop of analyze, plan, execute, track, execute again, track again, and then ultimately come back and benchmark. This discipline is really critical, and that's what we're going to talk about today. We're going to take each element of this and drill into it, starting with how to assess opportunity. So key questions that you want to ask yourself in assessing opportunity start to me with how reliable is my funding source? How concentrated are my deposits? So deposit concentration has existed in our industry as long as our industry has existed. It's the 80-20 rule in terms of how it manifests itself in our operating environment. But this issue got elevated a year and a half ago when SVB Bank failed because concentration was such a fundamental component of why they went down so quickly. And so that renewed focus, I think, has probably been overdue, but it's very important. So you need to understand or know at a basic level your concentration ratios. Do 4% of your households control 60% of deposits, or do 2% control 67%? What are the implications of that? And most importantly, if 4% control 60%, how strong are my relationships with this 4% of households? And so benchmarking can help us assess that on a relative basis and then identify what's driving that relative risk that we may have there. So I'm going to show you an example of how we look at that here in just a moment. Single service usage, I think it's fundamental to both attrition risk, because single service households are more likely to leave you than multi-service, but also cross-sell potential, because by definition, we're only meeting one financial need in a single service household versus multiple needs. So what does single service usage mean relative to cross-sell potential, but also attrition risk? And by the way, when we refer to single service usage, we're ignoring the share account. So we're looking at outside of the membership account, what financial need are we meeting there? And what percentage of our households are we only meeting one financial need within the relationship? Number three, this is really important data, and this is where the limits of core systems can really be an issue. And that's distinguishing between new accounts and new relationships. So being able to identify how many brand new relationships, not just accounts, but new relationships did I attract in the last 12 months? And what is distinct about those relationships as contrasted with my overall mix of membership? How does my ratio of new divided by total members compare to my peers? And that's a form of a growth rate, if you think about that. Am I getting a normative depth of relationship when I attract a new member, or am I missing opportunities to capture the full wallet of my brand new relationships? That's really critical. If you think about the analogy of a crescendo in music, if the crescendo gets cut off on the left side, you miss that widened opportunity and everything that creates. And so understanding, how much of that I'm capturing early in a relationship versus having brand new members leave orphan accounts at their prior bank or credit union that they never move over. These are fundamental things you need to understand. One micro example of that is if you take your year-to-year change in deposits. So I grew deposits by $20 million last year. And you say, how much of that change came from brand new relationships? So what are the total deposits that new households brought me in the last 12 months? And how does that relate to the $20 million net change? That gives you some really good insights into your future growth plans, because that's telling you how reliant are you on attracting new members to grow deposits versus expansion of existing relationships. And if you think about, if you're building a deposit plan for 25, that's a fundamental thing to understand. And again, that benchmarking brings insight into those types of questions. Underfunded accounts is one of the most commonly missed opportunities for growth for community financial institutions. And there's a couple forms of this. Checking, I think we tend to assume that anyone who has a checking account with us, that checking account's funded to the level of their capacity. But that's never the case 100% of the time. And in many cases, as much as 10 to 20% of accounts can be significantly underfunded. And when I say that, what I mean is when you look at the profile of the member and you financially overall, and then you look at their checking account balance, there's a disconnect there. Their checking account balance might be, let's say, $2,500, but people that have their financial profile normally carry $25,000 checking accounts. So when we identify these disconnects, then we can look at, okay, how does that intersect with a product mismatch? So they have my basic free checking product and their balance is underfunded by 80%. I can offer them an upgrade to my premium product to help try to encourage fund up to the level of their capacity. Another example of that might be the most efficient per dollar way of growing deposits is what I call money market activation. So the member has a money market savings account with you. Their balance, the data says their balance could be in your top tier, but the balance is currently in your bottom tier. So simply communicating, hey, we have a tiered product. We pay you more the more you deposit. We're currently paying X for balances over 100,000. You will get members increasing funding in their existing money market account to try to earn a higher rate just by reminding them that that feature is fundamental to that product that they already own. And so data helps us, again, in benchmark data in particular, identify and quantify where those gaps exist so that we can then go after those opportunities to close those gaps. And that drives growth in these key categories. Number 5 here, to me, one of the fundamental aspects of relationship banking is members where we're meeting both their transactional need and their lending need. Credit unions do, frankly, a much better job on the consumer side of doing that than community banks. But we want to understand, where do I have opportunities to grow checking within my lending base? Where do I have opportunities to grow lending within my checking base, and be able to quantify those opportunities? And then that's where the benchmarking can help us quantify the amount of opportunity we have within a defined window of time. And then on the business side, for those of you who service business households, and are particularly those that are trying to build out your business lending portfolios, being able to understand to what degree do I have opportunities to expand my business checking, cash management type relationships into business lending, and being able to quantify that opportunity is fundamental to putting together a plan as well. So at Infusion, we have a couple of unique data assets that we deploy in trying to answer the questions that I just reviewed in the last 2 slides. The first is our national normative, which is a set of statistics on how consumers and businesses are currently using retail banking products. This normative database is updated every day with fresh data that we take in from credit unions all across the country. It's built on more than 10 billion data points. So it's a very deep statistical history to it. So what we're able to do is to take an extract of your institution's data, run a set of standardization routines against the data, and then calculate a whole set of statistics based on that standardized data criteria, and then compare those statistics to the current living, breathing norm. So again, the norm's updated every day. It's machine learning because data comes in from credit unions all across the country. The machine identifies new data files here, runs the standardization routines, runs the normative metrics, dumps it into the database. The database recalculates automatically, and we're able to compare your data to that living, breathing data set at a point in time to see how you compare. And again, that gives you that kind of comprehensive SWOT analysis. What are your strengths? What are your gaps? Where are your attrition risk factors relative to your peer institutions? The second data set that we have that works in tandem with the first data set is our campaign tracking database. This is built on more than 100 million marketing contacts. It's also continuously updated. So that same process I described earlier, the machine identifies that we have a new data file from this client. It will also identify, again, this client has 6 campaigns that need to be tracked. It'll run tracking reports on those campaigns, and then dump all those statistics in the database and recalculate the norms for response rates, average balance, new versus repriced money, halo effects, retention benefits, all of these sorts of things. And so when you put these two tools together, it gives a very accurate way of assessing opportunities for individual institutions at points in time, because the national norm says, here are gaps and opportunities in key member segments. The tracking norm says, here are the most successful tactics at taking advantage of those particularized opportunities. And therefore, here's what you could expect to realize and impact in a defined window of time if you undertook these particular types of opportunities. So these are kind of our key tools in doing that opportunity assessment function for clients. And that's what's driven the 18 billion in results, has been that being able to deploy these tools for clients. So some of the specific metrics that we deliver to you through the assessment are product ownership rates and funding levels for the full range of product categories compared to peers for both business and consumer households. So that allows us to identify gaps in individual categories like checking, broader deposit products, various savings products, certificates, installment lending, home equity, mortgage, credit card, et cetera. And then we're able to provide pro forma projections for how much of those gaps we can close on a 12-month planning cycle based on particular tactics and strategies. I talked about new households earlier. So we have a whole series of benchmarks on new household formation rates compared to peers, wallet share capture of new relationships in the first 12 months compared to peer, and adoption of digital services for new checking households compared to peer. And by being able to do those benchmarking, we can identify where you may be coming up short. In some cases, we're able to help clients to validate technology projects that they have, because we're able to quantify the gaps that are developing based on limited functionality they may have on things like online account opening, by showing how those gaps develop based on those limitations. I also talked about single service usage earlier. So being able to go category by category and show what percentage of your checking household, savings households, money market, certificates, installment loans, home equity, credit card, mortgage only have that particular product when you ignore the share count. And therefore, we have cross-sell opportunities into other categories, but also potential for attrition as well. Deposit concentration, again, really critical view. I'm going to show you in just a moment a whole series of benchmark views that we have against concentration ratios that bring insight into the reliability of your funding base and ways to solidify the reliability of your funding base without constant pressure on deposit rates and margins. I talked about dual usage of checking and credit products. We have a whole series of metrics on checking penetration of various credit households and credit penetration of checking households. And then, we can use all of these things to model out deposit growth scenarios at various cost of funds levels to try to optimize the level of funding growth you need to the cost of funds, the best cost of funds available at that point in time. So one of the things I talk about with clients all the time is, in terms of funding our balance sheet, our challenge is always, how much funding do we need, and what is the most efficient available cost of funds scenario at the point in time to meet that level of funding need. So the first part of that's easier to determine, how much funding do I need to fund my balance sheet. The second part, where do I even start in terms of determining what's the most efficient cost of funds scenario available? But that's where looking at your product mix and funding level gives you direct, especially in a benchmark view, direct numbers on ways to optimize overall funding across category to get the best overall blended cost of funds with the volume of deposits I need. So really critical where data can be helpful. And then just more broadly, being able to look at what are key demographic attributes of our membership compared to the markets overall that we operate in, and how do those comparisons give us insight and projectability into growth opportunities for new households. So deliverables with the assessment. First of all, it's an in-person presentation led by myself or one of our senior strategists with your leadership team. And so the data itself is valuable. It's uniquely insightful, but the conversation adds even more value. I do these every week. I'm in California now. I did one of these yesterday for a credit union out here. And as I go through data every week, and our team goes through data every week with folks like yourself, we have conversations with clients about what are the things you're doing to drive differentiation in key metrics. And so we work very hard to cross-pollinate those types of things as we meet with folks like yourself. And so it's not just the data itself, it's the conversation that brings really insight, and insight beyond marketing to things like product features and benefits, product mix, pricing, sales effectiveness, these sort of things. The OA is a 40-page document. You get a copy of the document with detailed recommendations for implementation. In many cases, clients are able to take those recommendations and use them to improve things they're already doing. But we also, as part of that, include engagement options if there are opportunities in the data that you're just not going to be able to get to on your own, that you might want to consider partnering with Infusion to go after. And so those engagement options give you ways to evaluate, potential partnerships and sync that up with your budget parameters. So a few screenshots of opportunity assessment that relate to things that I've talked about here. And I'll start with deposit concentration. And I love this view of the data because it integrates a balance sheet view with a relational view in really uniquely insightful ways. We don't think you have to choose between managing portfolios or managing relationships. We think you can do both at the same time. But to do that, it really requires the ability to integrate data like you're seeing on the screen here. So what we have here on the left are 6 ranges of deposits from $1 to $250,000 plus. The number of relationships this institution has that carry that level of balance with the institution, the percentage of balances they control, the percentage that have checking accounts with the institution, average checking balance, the percentage that when you ignore the share account only have one service with the institution, the percentage that have credit with the institution, and then you see a series of indexes interspersed throughout the table. So the index is where we compare the individual client's metric with the average credit union, and we use an indexing system where an index of 100 equals the average credit union. So if your metric has an index of 120, that means you're 20% above the average credit union in that metric. If your index is 80, you're 20% below. And so one of the things we do with this particular table is aggregate these top 4 rows, 10,000 plus. And that's this bottom row here, high deposit households. So these are households that have $10,000 or more with the credit union. So for this institution, that's 3,006 households, which is 36% of households. They control almost 300 million or 96% of deposits. So that 96% of deposits controlled has an index of 99, which is normal. Index of 100 is norm. But having 36% of households in that segment is 12% below norm. So that means you have elevated concentration, because anytime you have a lower percentage of depositors controlling a normal percentage of deposits, that means your funding base is more narrow than your peers, and you have greater concentration risk. It takes fewer households to leave you to make a more negative impact. And so we all know we have concentration because everyone does. Now we know we have concentration risk. It's a little bit elevated. So the key question is, how strong are my relationships with this 36% of households that are funding my entire balance sheet? So we would answer that question in 3 ways. Do we have their core checking? Because that transactional activity is an anchor on the overall relationship in terms of how embedded they are in our organization. Number 2, are we meeting one financial need or multiple financial needs within the relationship? Single service households are more likely to move on to another institution in multi-service because we're meeting a more limited set of needs there. And then number 3, do we have a loan relationship that anchors that deposit relationship in terms of keeping them tied to us over the longer term? So we'll start here again, keeping going from left to right on this high deposit household row at the bottom. So again, 96% of deposits controlled. If we keep going to right here, you see we have 83.7% of high depositors have checking with this institution. That's an index of 102. So that's good. That's above norm. But as we go up into the higher tiers, you see a gap develop in the top 2 tiers where now they're below, the index is below 100, which means they're below norm. Only 71% of their highest depositors have checking, 77% of the next tier down. Both of those are below norm. And then you look at these average balances, 169,000, 76,000, 41,000. So, one of our unique challenges right now is over the last year and a half, as rates have gone up, we've seen a massive outflow of checking deposits back into a more traditional mix of deposit of savings products. And so, during the stimulus, checking balances magically grew even without account growth. Now that's completely reversed. And if we just want to try to hold on to some semblance of checking in our funding mix, we have to grow accounts. And if I'm going to invest $1 of marketing to grow checking, I want to start in these very top tiers, because when I'm successful, number one, I get high balance accounts, as you can see from these averages here. And number two, I protect relationships that are disproportionately important to my funding base. So anytime I can spend one marketing dollar and achieve those two goals, quality growth and prioritize retention benefit, I want to spend that marketing dollar every day of the week. And next best product type models miss out on these nuances because they're very efficiency driven, response efficiency versus retention priority and quality of response. And so this is where a great example where a benchmark analysis identifies these gaps and opportunities and then helps us to quantify them based on the norm comparisons. Single service usage. I have a colleague that likes to say, with single service indexes, you're playing golf because a lower score is better. That means you have less single service households. And you can see here, they're 30% above norm across the range of deposit tiers in single service usage, which would correlate with higher attrition risk because, again, you're meeting a more narrow range of needs. So we want to prioritize retention in these key segments. I know when I was a banker, we had a lot of committees at various times about we need to put some focus on retention and try to mitigate attrition. And those things can be valuable, but the starting point on retention management is prioritization. So what's the intersection of likelihood to leave with negative impact, level of negative impact if they did leave? And so this table gives you that because you're able to intersect. I'm only meeting one need here, and yet these people carry very high balances. And so you can kind of circle the number of households in these top 2 or 3 tiers that are single service with balances over 50,000. And it's a small enough quantity that we can distribute these to branches and we can focus on them in our marketing to try to really make the most impact financially on retention as we take those types of activities. Finally, we know higher depositors don't borrow as frequently as lower depositors because they don't have as much need, but they do still borrow. And the indexes demonstrate, in this case, that this client's about half the norm in credit penetration in these highest deposit tiers. And again, I will go back, it's a prioritization thing. So yes, high depositors don't borrow as often, but when they do borrow, first of all, they're good credit risk. If I've got 70,000 in my checking, I'm going to pay my loan on time. And so you got high performing assets. And number two, if I sell, let's say, a home equity line of credit to a high deposit checking household, not only do I got a high performing asset, but I put a multi-year retention on that high balance checking account in the form of the loan term. So again, if I'm going to spend $1 to grow home equity, I want to start in these top tiers where I get quality assets with prioritized retention benefits. And by the way, if Wells Fargo does a home equity with one of your high deposit checking households, they're going after the checking account as part of the sale of the loan. And they're going to offer a discount on the HELOC to get the checking. So it's a defensive measure as much as anything else to meet that need in that relationship, to preserve that deposit as much as it is to grow loans in that particular instance. So a couple of other interesting views here. Single service households. And again, when we define single service, a couple of things. First of all, we ignore the share account if it has less than $250 in it because we're trying to we don't want to count a pure membership account with $5 or $25 in it as a service, because that's not meeting a particular financial need. The second thing is we ignore debit card, online banking, don't treat them as services because they're ancillary to the checking. And so when we do that, we're able to then answer the question, what percentage of my members in each product category only have that category product? So in this case, this institution has 4,128 checking households that only have checking. That's 56% of their checking households. And so those are important numbers to know. Now, average balance is $12,000. So that's important. When you start to say, well, how would I target into these 4,100 checking households where by definition, I don't have their savings wallet and I don't have a loan, they don't have loans with me because all they have is a checking. The building blocks for effective targeting are capacity or the means to buy and propensity or inclination. So if I take this 4,100 checking households, the checking balance is by far the most predictive capacity indicator. The amount of money someone keeps in their checking from month to month to month to month tells you a significant amount about A, their credit worthiness, and B, their likelihood to have money somewhere else. So I can stratify this 49 million in checking balances and target those in the higher balances. And you see interest checking here, there's 399 households with a $35,000 average balance. These people have money somewhere else. I know who they are. I can target them to try to get them to move those deposits over. From a propensity perspective, we have 2,696 over here on the right that have active debit cards. Okay, those are people engaged with my brand every week because they're using my plastic. And so when you put that criteria, okay, I got active transactional behaviors with high balances in the checking, that's a great audience to go after expansion into a second, third, or fourth service by leveraging off that checking into the savings wallet or into a loan relationship. Now, from a retention perspective, you see savings money market, and you see about 5 million in savings and almost 8 million in money market, so almost $13 million between those two categories. These are deposits held by households that only have a savings or only have a money market. So it's a liquid account. It's not anchored by checking. There's no certificate. There's no loan. They can move all that money tomorrow if they wanted to. We know who these people are. In the case of money market, it's only 76 households that control almost 8 million in deposits. We want to get these people into checking. We'd rather not have to go replace this 8 million with more expensive money from outside the institution. So again, we can benchmark all of these, what percentage are single service and what are the balances to peers. And so that's part of what we do, which helps us then assess how much of that gap can we close. Here we're going back to high depositors. So if we go back to our deposit concentration table, we had 3,006 high deposit households. You can see on this table, they average 3.15 accounts per household. So we have a benchmark on that. For checking, 84% have checking accounts. Average balance $42,000. This is my point. If I'm going to sell a checking, I want to start with the 16% of high depositors that don't already have one, because I get these high balance accounts when I'm successful. Beyond checking, in terms of broader deposit gathering, if we take, sometimes the simplest math is the best math. 2,500 high deposit checking minus 300 high deposit money market means I have over 2,000 high deposit checking that do not have a money market with me. The ones that do, the average balance is 124,000. And so if I can target into this 2,000 high deposit checking without a money market, promote my money market product, and particularly focus on those that are actively transacting, I don't have to promote rate to get them to open the money market, because I can leverage that checking to promote liquidity, access, being able to access funds and online banking and transfer money back and forth between checking and money market. I have a tiered product. The more you deposit, the more we can pay you, rather than using a promo rate that comes with an interest expense. And then I have to try to sustain that deposit in a declining rate environment once that rate expires. And so it's all about targeting. If I'm targeting those folks who are I already have their checking, they're already trusted me with, say, 25, 35,000 in the checking, and they're going to bring me another 50, 60,000 in the money market. And I can do that without having to use a promo rate. That's a more sustainable way of growing deposits. that not only gives me new money market deposits, but helps protect that checking relationship by adding value to it in the form of that money market account. I would just make the case, having lived through this as a banker, these cycles, the money market, I think right now, with the uncertainty about future rates, is a great tool because it gives you flexibility to adjust your pricing, but based on what actually happens with the Fed, and also adjust your tier structure. Generally speaking, as rates decline, you want to reduce your number of tiers to create more interest income. When rates are going up, usually you add tiers that help create more granular pricing to expand your margins that direction. So the money market I like, of course, if you're, but there is an analogy with certificates. If you're still trying to fund a portion of your balance sheet with certificates, to the degree to which you're selling a certificate to a transacting high deposit checking member, there's less price pressure than if you're trying to sell that certificate to someone off the street who does not bank with you, and who's, because of that lack of history, you're going to have to pay them a premium to get them to induce trial of your institution. If we look down here in the bottom left, these are high deposit households. Only 1.7% with this institution have a home equity. These are folks that have high property values, chunks of lendable equity. That obviously the checking balance tells you the credit quality is very high. And so when we take these product penetration rates, we can compare them to the average credit union on the left here, where the 100-yard line is the average credit union. You see the various products. If we come down to home equity, that 1% penetration is 90% below norm. So that's a quantifiable gap. I can run a math calculation to say, if I could just penetrate the home equity product in this segment to where the average credit union is, what would that add in terms of home equity accounts and balances to my portfolio? And then, of course, that's where the tracking norm says, and what's the most effective way of closing that particular gap in terms of offer strategy, channel mix, frequency of outreach, all those sorts of things. You can see here there's also a gap in the money market that's quantifiable. So how much deposits could I grow in money market by just getting to where the average credit union is for penetration of that product category in this segment? Again, that's where benchmark analysis gives you quantifiable opportunity that you can then go build plans against. Single service business households. And so this is the case with, I would say, 90% of credit unions. Well, let me state it differently. For credit unions that serve business households, 90% of their business households are transaction only. So credit unions that serve business households, 90% of those households only have a transactional relationship, no credit relationship. And so if you think about it, the amount of money a business keeps in their operating account is super predictive of your likelihood to be able to underwrite them for, let's say, a business line of credit or a commercial loan. And so being able to benchmark my single service transaction levels to peer helps us then quantify how many loans could we add to these single service relationships and be able to grow in our loan portfolio. In this particular case, this client has 3,500 single service business checking households, and their average balance is 57,000, which is 26% above norm, which would indicate credit capacity. So I can start to assess how many of those 3,500 could I target for a business credit product, and how much of that could I plan for my 2025 budget using these benchmark tools. I mentioned dual usage of checking and credit products. So what we have here are some benchmarks. On the top three bars here, what percentage of my credit households own a checking with me? So for this institution, 77% of home equity households have checking. That's 12% above norm. That's good. 61% of mortgage households have checking. That's 27% above norm. That's really important. A mortgage household with checking is 2 to 3 times more likely to subsequently do a home equity on that same property. So understanding where you stand and meeting the checking needs of your mortgage households is fundamental to then also projecting your ability to grow home equity within your mortgage base. Now, this client has a gap in installment loans. So the direct installment loan households, only 52% have checking. That's 27% below norm. So I can run a simple math calculation to say, if I could just penetrate my installment loan households with checking at a normative level, what would that add in checking accounts to my checking base. And how would I go about doing that, based on the tracking database? You can see this is interesting. Even though this client's above norm for checking penetration of mortgage, they're below norm for home equity penetration of mortgage. So that is a clear opportunity. In fact, that home equity penetration of mortgage index should mirror the checking penetration of mortgage index. So it's an even bigger gap than it looks like, because when you compare those two categories, you should be paralleling each other. And you can see more broadly, home equity is a definite opportunity in these other categories as well. And then the direct loan penetration is relatively low. We also have benchmarks for credit card penetration of mortgage, home equity, checking, and installment loan. And so you want to particularly look at your direct loan penetration of credit card and your credit card penetration of direct loan, because the underwriting is fairly similar and there should be a lot of crossover there. And if there's not, those quantifiable gaps can help us to determine how much growth opportunity we have. And if any of you are trying to transition away from indirect to direct lending, these sort of gaps can really help to justify that strategy decision by quantifying how much direct installment loan capacity exists within your broader member base to replace indirect lending that you're already doing. So some key principles in putting this sort of data to use. The first is an obvious statement, but it's fundamental to deposit gathering. There's a trade-off between volume and margin. You all know if you pay the highest rate in the market, you can generate a volume, but you sacrifice margin. And so this is what I mentioned earlier. We want to assess, based on our volume need, what's our most efficient cost of funds scenario available to me at this point in time. And again, this type of data analysis can, in a very tangible way, an actionable way, assess that. Number two, I think when rates are elevated, as they have been, and even with the cut, they're still elevated, our instinct is, well, we're only going to make our best rates available for new money because we don't want to reprice existing dollars. And that's completely understandable. But the problem is, new money depositors require higher rates because they have lower propensity to bring you that deposit because they haven't trusted you with their money before. People that have already trusted with you with their money are willing to accept lower rates because they have that trust factor, they have that relationship factor that offsets the price pressure. So if I could pay an existing depositor 4% for a 12-month certificate instead of having to pay 5% to someone who doesn't currently bank with me, that 100 basis point difference is a real financial cost. And in most cases, it's a lot larger cost than the actual disintermediation cost of repricing. But a lot of clients just take a caveman approach, repricing bad, new money good, therefore best rates only available for new money. Do the actual math, look at the data and say, where is my most efficient scenario? And that's where our tracking database allows our strategists to say to individual clients, if you're looking for 10 million of deposits at, let's say, a 9 to 12 month terms and certificate terms, based on actual campaign response in those terms for your credit union peers in defined segments, and based on your quantity of those same segments, here's what you could expect at 4%, 425, 450, 475. And then you're able to take that into your pricing committee or ALCO and make an informed, data-driven decision about how to price your deposit offers instead of just matching what they're paying down the street. Number three, the most efficient source of deposit growth is existing high depositors. The more they have with you, the more they have somewhere else. The single most consistent thing I've seen in 35 years of doing this, and I'll show you evidence of that in a moment. So as our business has become a digital business over the last 5 years, 6 years, as we've given members technology to service their accounts so they don't have to come to branches as frequently, the pandemic have forced even a lot of the holdouts to adopt those digital behaviors. And of course, while all that was happening, we have this growing plethora of fintech, online savings, online lending providers that we have to compete against. And these providers are low friction, well priced alternatives to our services. That digitization of our business there's an opportunity cost associated with every conversation that used to happen with a member in a branch or on the phone that is not happening today. And this should make marketing a more primary critical component of your growth strategy than it's ever been, because in many cases, marketing is the only way I have to initiate a conversation with a member that would not otherwise take place. So really, really critical concept there. If you're going to exist in the digital landscape that banking is today, 5 years from now, 10 years from now, you've got to become an effective digital marketer. It's just a fact. Number 5, when it comes to lending, members don't determine their borrowing needs based on when we decide to do outreach. So consistent, continuous awareness building in high capacity, high propensity segments is fundamental to continue to be able to sustain growth. Finally, here, I alluded to this already, but the best retention tool is proactive cross-selling. Waiting till a member has a foot out the door. It's very inefficient to drag a foot back in the door. In contrast, meeting a wider range of their financial needs 6 months earlier, 12 months earlier, 18 months earlier prevents the foot from going out the door in the first place. Okay, so as we transition here into planning, one of our mantras is the most effective on a per dollar return on investment basis. Digital marketing starts with the audience, not the channel. Rather than saying, how am I going to use social media? You should start with, who does the data say I should be communicating with, and how can I find them in online environments? And so these are all audiences from a recent assessment where that we identified for a particular client. New households, 3,800. High deposit without checking, 10,000. Business households without checking, 2,300. Homeowner, non-homeowner, and business lending opportunities. So these are all discrete households, audiences. We know who they are. We can create files of them that we can then match to digital channels, and then we can then put on an always-on continuous marketing programs like you see here. And so a pixel in one of these boxes is a message placed in front of one of these households during this window. The boxes are then where we stop and measure at the end of each campaign and determine how many accounts did we actually generate. So throughout the campaign, we're evaluating impressions, clicks, accounts opened, and then at the end of each quarter, what's the final wrap up of results? How do those results compare to what other peers saw during the same period? And what does that tell us about our opportunity to do something different? So with our tracking database, what we have the opportunity to do for individual clients is to take these quantities in particular segments and subsegments, dump them into the database and say, if these segments continue to perform at their current trend for other credit unions, what would that yield for this client? So for this client, we identified about 25 million in transactional balances, another 100 million in other broader deposits, and then 100 million in loans based on a schedule of outreach like the one you see here. So if you executed this entire calendar of outreach against these audiences, you could expect to see this many accounts and this many balances generated. And then halo balances are additional balances opened by people who responded to our primary offer. And then contribution, of course, is the amount of income that the response activity generated based on the net interest margin of the response balance for that particular institution. So that pro forma projection gives us a way to sync the analysis to our budget goals, and then start to assess what should we be investing in each component of these different transactional, broader deposit gathering and lending opportunities that we have in the data. But we've got to be able to act. And so some of the key considerations and actions here in our last 5 minutes. This type of data-driven approach allows for more modest deposit pricing because you're driving growth based on relationships versus price, which takes pressure off short-term margins and pressure off downstream retention of those dollars in terms of the expectation of pricing going forward, which can be critical as rates go down to reduce the amount of expectation and pressure on longer, future interest rates as certificates mature and so forth. We want to be able to trade off flexibility and liquidity as in our marketing as much as yield. So we know yield drives volume, but there are other things that can help us drive volume in terms of flexibility, liquidity. One of the things we like right now when it comes to certificates is pick your term. So our rate's 4%. Each year is a combination of terms between 6 months and 36 months or whatever it is, which encourages laddering and disbursement of maturities among the audience and sales fulfillment channels. But it also can offset that top line yield with flexibility and that choice element there. Marketing has really become our rate card. No one sees the rate card that's in the desk drawer anymore. Marketing is largely the way we communicate what we have to offer on deposits. So thinking about marketing as a tool to manage your portfolio is a fundamental shift towards being a digital organization. Onboarding new members is not just about debit activation and mobile adoption. It's also about capturing the full financial wallet, deposits and loans of new members as they come into the institution. That wallet varies widely from member to member, which is why you've got to use comprehensive data, life stage type data appended to new household records to do onboarding message tracks that are relevant to different segments that drive that wallet share consolidation in that key early period. With lending, we want to mine our checking base to grow loans where we're not currently meeting the lending need, while we're also expanding current borrowers into new categories. Doing that, we want to assure members that we know they're unique and we have a variety of ways of addressing their individualized needs. So even while we're featuring a particular product in our marketing, we understand the goal is to get them into the top of the funnel, and they may end up in a different product based on their particular limitations or needs or preferences relative to the borrowing process. So finally, tracking here, quick correlations, deposit, and this is particularly certificate, but response rates and average balances on deposit cross-sell correlate with deposits pre-campaign. The more they have with you pre-campaign, the more likely they are to respond on the left, and the more dollars they bring you. So people that already have 50,000 with you are several times more likely to respond to your cross-sell offer. And when they do, they bring you larger chunks of balances because they have more capacity. The more they have with you, the more they have somewhere else. It's exactly the reverse on response to loan campaigns. The lower the deposit levels, the more likely I am to borrow because the more likely I am to have a borrowing need. However, when I do borrow, higher deposits predict credit capacity, larger chunks of borrowing based on wherewithal, property values, these sorts of things. Response also correlates with number of services. The deeper my relationship goes, the more goodwill I create, the more institutional affinity I have. And so it's easier to sell a 6 service to a member that already has 5 than it is to sell a second to a member that only has 1. And so your cross-sell efforts actually build on themselves. As you succeed today, it actually increases your likelihood of succeeding again 6 months, 12 months, 18 months down the road. Number of channels also predicts response. The more ways I can show the message, the more likely members are to respond to the message. So this is a case study, credit union out in the West Coast, where with onboarding, we were able to show an $8 million lift in checking fund up in the first 4 months. So members that were targeted in onboarding with this multi-track, data-driven onboarding communication, if they had the same fund up level as randomly excluded members during the same period, this credit union would have 8 million less in their checking portfolio, which at their net interest margin on checking is a 950% return based on the lift of the contact group to the holdout group. On broader cross-sell, we're able to generate $100 million in the first year at an estimated return of over 800% and correlate the click activity to the actual open account activity during that period. This is an example of a scorecard that shows clients campaigns in market, impressions, clicks, opened accounts, balances, marketing expense incurred. We provide that. I'm going to flip forward here to the very end. You'll see these additional slides in the document if you are able to download that. But key takeaways to this presentation: there's never been a better time to benchmark your data. Again, based on everything that's happened in the industry in the last 5 years and what's likely to happen in the future. Number 2, The digitization of our business should make marketing a more critical part of your growth strategy than it's ever been. And the ability to integrate marketing into your analytics and your budget planning in this type of tangible way is critical. Number three, marketing is not financially accountable in terms of tracking and analysis. Can't meet the challenge of bullet point number two. So you've got to be able to have that. We bring that to clients in terms of accounts balances, but also broader relationship impacts and peer group comparisons of results. So we would say this final statement: the discipline to act on opportunities as they present themselves in your member data, and the ability to measure the impact of those actions and adjust course is what's going to separate winners and losers, who are still going to exist as institutions 5-10 years from now versus those that will not. And so, again, we're offering this assessment free for everyone who attended here. We normally charge for this, and I can promise you it will be uniquely insightful to your institution. So I hope this has been valuable to you. I appreciate your time and patience and attention going through the data, and happy to field any questions through the chat or as a follow-up to this as well. So, Sean, I'm going to throw it back to you.
Thank you, Tim. As Tim indicated, if you have any questions, go ahead and put those into the chat or the Q&A box. We'll certainly take those. As Tim covered today, we'd certainly welcome the opportunity to provide you with an opportunity assessment. So certainly reach out to us or actually, I'll give you the information on the slide here at info@quickrate.com. You can call us. You can reach out to one of our customer service or sales reps, and we can get you set up. But I think, needless to say, the amount of information that's available to you and can be gleaned from your own data is staggering. And so, really look forward to the opportunity to let one of our strategists, talk to you about your information from an opportunity assessment. I don't see any questions or chats. So on behalf of Tim, thank you all so much for joining us today. And we'll look forward to seeing you on a upcoming future Infusion or Quick Rate webinar. Thanks again for taking some time out of your day to join us. Have a great day.
Everybody. Bye.